Inflation, the persistent rise in prices over time, is a fundamental economic concept that affects individuals, businesses, and economies at large. While moderate inflation is considered a sign of a healthy economy, it is important to understand its potential to harm people's wealth. In this video, we will explore the impact of inflation on personal finances and discuss strategies to mitigate its effects. First of all, what exactly is inflation, and how is it calculated? Inflation refers to the general increase in prices of goods and services over time. When inflation occurs, the purchasing power of a unit of currency decreases, meaning that you can buy less with the same amount of money. Let's use a hypothetical example to calculate the inflation rate based on the Consumer Price Index, CPI. Suppose we have data for two periods, the base period, year 1, and the current period, year 2. Here's the data for a simplified market basket of 3 items and their respective prices in each period. The items are apples, gasoline, and a movie ticket. The price in year 1 is $1 for the apples, $2.50 for the gas, and $10 for the movie ticket. In year 2, the price for the apples have increased to $1.20. The gasoline is now $2.80, and the movie ticket now costs $12. To calculate the inflation rate, we'll follow the steps mentioned earlier. 1. First, we need to select a base period. Let's assume year 1 is the base period, assigned a value of 100. 2. Next, we choose a current period. Year 2 is the current period. 3. Create the market basket. We have a simplified market basket with 3 items, apples, gasoline, and a movie ticket. 4. Gather the price data. We have the prices for each item in year 1 and year 2. 5. Calculate the price index. We'll calculate the price index for year 2 relative to year 1 using the formula price index equals total cost of market basket in year 2 divided by total cost of market basket in year 1 times 100. Total cost of market basket in year 1 equals $1 times 1 plus $2.50 times 1 plus $10 times 1 equals $13.50. Total cost of market basket in year 2 equals $1.20 times 1, $2.80 times 1, plus $12 times 1 equals $16. Price index equals $16 divided by $13.50 times 100 equals 118.52. 6. Calculate the inflation rate. We'll calculate the percentage change in the price index using the formula inflation rate equals price index in year 2 minus price index in year 1 divided by price index in year 1, all times 100. Inflation rate equals 118.52 minus 100 divided by 100, all multiplied by 100, equals 18.52%. Therefore, based on this example, the inflation rate between year 1 and year 2 is 18.52%. This means that on average, the overall price level increased by 18.52% during this period, indicating inflation. Now that we know what inflation is and how it is calculated, we will now look at how we can protect ourselves from inflation. Individuals with fixed incomes or limited savings face the greatest risk as their purchasing power gradually diminishes over time. To safeguard wealth against inflation, individuals should consider investment strategies that outpace or hedge against rising prices. Diversifying investments across different asset classes like stocks, real estate, commodities, and inflation-protected securities, such as Treasury Inflation-Protected Securities or TIPS, can provide a hedge against inflation and potentially maintain purchasing power. When investing in stocks, there are several ways it can help you against inflation. Stocks represent ownership in companies, and historically, well-managed companies have shown the ability to grow their earnings over time. Inflation often coincides with economic growth, which can lead to increased revenues and profits for companies. As a result, stock prices may rise, providing investors with the potential for long-term growth that can outpace inflation. Certain sectors and industries have historically demonstrated the ability to outperform during inflationary periods. These sectors often include companies involved in essential goods and services such as healthcare, consumer staples, and utilities. By strategically allocating investments to sectors that tend to be less impacted by inflation, Investors can mitigate the potential negative effects of rising prices on their portfolios. Investing in global markets can provide additional diversification benefits, especially during inflationary periods. Different countries may experience varying inflation rates, and by investing in international stocks, investors can access regions with lower inflation rates or economies that benefit from specific factors that counter inflationary pressures. If you choose to invest in rental properties, you can benefit from the potential for increased rental income during inflationary periods. Inflation often leads to rising rents, allowing landlords to adjust rental rates to reflect higher living costs. As a result, rental income from real estate investments can provide a steady stream of cash flow that may keep up with or even outpace inflation, helping to protect your purchasing power. Commercial real estate leases often include clauses that account for inflation, such as annual rent increases tied to the Consumer Price Index, CPI, or other inflation measures. These inflation-adjusted leases provide a built-in protection mechanism as rental income automatically adjusts to reflect rising prices. When investing in commodities, there are also many options that you can use to protect yourself. Commodities are tangible assets that have inherent value and are often used in the production of goods and services. These include essential resources such as oil, natural gas, precious metals like gold and silver, agricultural products, and more. As prices rise due to inflation, the value of commodities typically increases as well, as they are directly linked to the supply and demand dynamics of the global economy. Investing in commodities can help diversify your investment portfolio. Commodities tend to have a low correlation with traditional financial assets like stocks and bonds. During inflationary periods when financial assets may be negatively impacted, the performance of commodities may be less affected or even move in the opposite direction. Adding commodities to your investment mix can potentially reduce overall portfolio volatility and provide a hedge against inflation-induced market fluctuations. There are various investment vehicles available to gain exposure to commodities, such as commodity futures contracts, exchange-traded funds, ETFs, and mutual funds specializing in commodities. These investment vehicles allow investors to participate in commodity price movements without physically owning or storing the underlying asset. They offer flexibility and liquidity, making it easier to incorporate commodities into an investment strategy aimed at protecting against inflation. Inflation-Protected Securities, IPS, such as Treasury Inflation-Protected Securities, TIPS, have emerged as a valuable tool for safeguarding wealth in inflationary times. These bonds adjust their principal value in response to changes in inflation, shielding investors from losing purchasing power. With their built-in inflation hedge, IPS offer peace of mind and the potential for steady returns even amidst rising prices. Another way that you can protect yourself as much as possible against inflation is to explore avenues for increasing income streams. Individuals can consider side businesses, rental properties, or alternative investments that generate steady cash flows. Supplementing existing income sources with additional streams not only provides a buffer against inflationary pressures, but also offers the potential for wealth accumulation. To sum up this video, to protect against inflation, individuals should consider investment strategies that outpace or hedge against rising prices. Diversifying investments across different asset classes like stocks, real estate, commodities, and inflation-protected securities, IPS, can provide a hedge against inflation and potentially maintain purchasing power. Make sure to subscribe and watch the other videos on the channel for more investing and finance-related content. See you soon!